Hi, guys. Welcome to our first episode of Finance Talk. And for those of you who are new to this channel, my name is Eugene. And here is today Nick. And we will speaking about different financial topics and the topics about investing. But first of all, let us introduce ourselves.
So I come from a very tech background. I'm a bit of a polymath, which means that I am well versed in many topics. So a lot of my background would be programming, search engine optimization, entrepreneurial activities, sort of data analytics type of things. And when I came across investing, it became my passion. And so my goal is to read 500 investing books and become a decent investor. And so I'll share some of the things I've learned, and we can learn together and discuss, investing stuff together. Over to you, Eugene.
I also have the background in IT, search engine optimization, website and app development. I've been doing this stuff for more than 10 years, and I primarily work in my own companies, so like startup companies. And some of them were sold to private investors, and some of them I run nowadays. And a couple of years ago, I started really dig deep into investing world and improve my skills and knowledge in this field. And my aim is to set up the fund and to help others to be better investors and understand more in finance world. One of the topics which we discussed before starting our call today is the interesting and latest news about the inflation, because most of people are really worried about that. What do you think about that, and what are your thoughts about the current inflation situation?
Sure. Well, I think inflation is a very good topic to start this on. I think that we should have been taught at school about inflation and investing. Essentially, to really summarize it, the average inflation in a good first world country is between 3 and 6% on average over a large period of time, 10, 20 years. And the problem with that, it doesn't sound like a lot, because if you buy a can of beans for $1 and next year it's $1.03, that's 3% inflation, it doesn't feel like much. But if you compound it over 20 years, between 3 and 6%, you're going to be losing about half of your spending power. So if you save $1,000 in the bank, 20 years later, you can only buy $500 worth of stuff.
Yeah.
And so you're kind of losing the money that you've worked so hard for. And the only way to combat that is to invest. It's the only solution. And a true investment is something where your capital isn't at a tremendous risk. You have almost a certainty that your principal, your initial capital, is going to be okay, with a high degree of certainty that it's going to grow at least at the rate of inflation to combat that problem. Obviously, we want to do much better than that, and that's where great wealth can be created. And so you have to invest in things that are cash generative, or compounding your money. And that would be something like a business. And a business can be renting a house that you bought, or it can be owning your own business, or being a part owner of another business with other partners, where you own a share of the business. And that's where shares come in. You're a part owner of companies that you buy shares in. You might be a very small owner, but you are owning that company in the same way that you would own a regular company. And so effectively, we are here to talk about what is a good investment, how to do it right, and how to make sure that you're compounding your money.
So when you remember the 72 rule, so if we just take 3 or 4% inflation, it's just more than how much? 24 years, kind of, yeah. So your money will be swiped out. And if we take 9 or 10%, in almost 7 or 8 years, you will lose 100% of all your money, which you worked so hard in order to get. And as you said previously, we here are more value investors, and we look for companies which are inflation adjusted, so they are not dependable on the inflation at all, or even though they can be hard or hit by the inflation, we need to buy them at a certain point where we are protected from that. So even if the company makes, I don't know, maybe 15 or 20% per year in their revenues and income, and the inflation is 5 or 10%, we can deal with that.
So the reason we invest in businesses is because when there's inflation, the business, whatever it's selling, goes up with inflation. So if they sell a product for $100 and inflation comes and it's $103, they don't keep the price at 100, they take it up to 103. And so our investment effectively protects us from inflation. And as the company grows, that's where our profits really lie. They suddenly make more sales. They're a bigger company. They open a new branch, a new division, and that's where our real growth comes from. But just by being in a company, their cash flow goes up by the amount that inflation does, and so it's an automatic protection against inflation if you've purchased a good company. Another thing that Eugene has mentioned, which is important to distinguish, is we do what's called value investing. And the reason we call it value investing, most people don't know, is because for us, a real investment is when we know the value of what we're purchasing. Other kinds of people who call themselves investors, they don't know the value of what they're purchasing, and so they're not value investors. They are speculators. That's where you speculate that the price of what you're buying will go up because somebody else will buy it at a higher price. And that is speculating. Real investing is always value investing, where you know the price. Not the price, you know the value of the thing you're buying. And that way, you know if you're buying it on a sale or on discount, if you've got a large margin of safety because it's lower than the value and you're doing a good purchase. And you know if it's overvalued, if people are charging way too much for it, and you know that that's not a good deal, and so you don't buy it. But you can't do it if you can't calculate the value. And so all good investment is value investing, and that's what we talk about here on this.
This is what we talk about our week meetings of the value investing group. So if you are also guys are interested in that, you can also join. I will put the link in the description. So when we do the value investing stuff, so the main idea of that is that we purchase the share thinking purchasing the part of the business. So and when we purchase the share, we think ourselves as the owners, and we think, okay, so is the management is really good enough to help and to protect the business from the inflation, from the different competitors, and can they really produce the good returns? And if we're confident in the management, and if they have different skills and enough knowledge to really perform well, I think that we can be both protected from the inflation as well. But the idea of buying the companies which are really protected and really have the kind of moat against the inflation is really good. You know that I'm the fan of Manish Pabrai, and one of his main quotes is that you have to find the business which can raise the prices without hurting himself. So if the company which we are buying can raise the price for its product or services, and the customers of this business cannot go to different competitors and they just have to stick with those increased price, this is the good company for us because we are protected in this situation and we are protected from the inflation as well.
I like that you brought up Manish Pabrai. I will give one of his quotes as well. But first, before I do, what I look at for investments is just three things in a very, very summarized form. Is I'm looking for reward. So I want my money to grow. I want to minimize risk, the risk that I could lose my capital. And I want certainty, as much certainty as I can, that those two things are accurate, that I'm going to have a high return, a low risk, and I want certainty of that. And that's kind of what I'm looking for. Now, Manish Pabrai, how he kind of tackles that angle is he says, I'm looking for businesses that I can understand, and that is very rare. There's like 9,000 businesses that you can invest in America, and there's 54 or 144 globally, depending on how you look at it. And he says it's very difficult to find businesses that you can understand fully enough to be certain. And then of the ones that you can understand, you also want ones that you can try to to understand the trajectory, where that business is going in the future. And the longer you look out, the harder it is. And sometimes it's very hard to tell the trajectory at all. So we look for companies of that sort, and that's what he says is what he's looking for, and that's a very summarized version of what we do. I also like Warren Buffett and Charlie Munger. Their job description is reading and thinking, and I like that a lot.
Yeah, that's really great. And actually, Manish, he travels a lot and he also reads a lot. And by doing that, he expands his circle of competence, as modern and popular value investors say. So you basically improve and increase the amount of knowledge you have in a particular field, because it is really easy to go on different occasions and different spheres and be kind of on the top of that. But we need to really dig deep. And one of the quotes is that you need to be 1 inch wide and 100 inches below the surface in order to really understand the business. And this works for most people nowadays as well. So if you are really skillful in the transportation or logistics or different retail stores, this can be your circle of competence as well. If you really like, I don't know, maybe gaming or traveling, this can also be your circle of competence. As Nick says, there are a lot of companies in the world, more than 50,000 of them, and you can definitely find the company which can be undervalued in this particular time, and you can actually see and look for company which are in your circle of competence.
I believe it was Warren Buffett who said that maybe it was Benjamin Graham, you can help me with the quote, who said it, Eugene. In the short term, the market is a popularity contest. And in the long term, it's a weighing machine. And what that means is that the market can be very unreasonable in both directions. In the short term, going with feeling and popularity and meme stock and excitement, and it can get irrationally exuberant, or it can be very depressed and go completely crazy in either direction. But in the long term, all that really matters is that the company has good cash flow, it's healthy, it has good management, it has good prospects, its growth is good.
Yeah.
And in the long term, it will price it accordingly. And so our job is to find when the market is irrationally mispricing the company too low, and then we buy it and we wait for the market to eventually weigh it correctly. And if we've done a good job using all of the methods we will discuss here, the profits can be very good in a very short time period.
Yeah, I agree. And actually, in this case, the inflation can be beneficial for us, because as we consider value investing as not the popular among others on the market, when other people feel really fearful about the current stock, about the situation, the overall prices can decrease. And as a result, we can go on the market and find the undervalued opportunities. Like currently, we spoke about the Facebook, which you really like in your portfolio. And this is really crazy, because currently most people think that Facebook is done, and the whole picture is completely different now in the Facebook, and it will go down, it will be broke, etc. But the numbers are really well.
So I think it's important at this point to just mention that we are not your financial advisors. We don't give professional advice. This should all be taken as education and entertainment only. You should make your own decisions and consult your own professionals. Now that I've said that, I can say that as of today's date, Facebook has been hovering between 150 and 170 for the last few weeks, and using discounted cash flow analysis, which is how I like to value businesses at the moment, I estimate that the company's current value should be more like 300 to 400. So it is at a margin of safety of over 50%. Buying in with my own estimation of timeline, how long the market will take to recognize this, I believe that buying it now would double my money within 2 to 3 years. And that is why I have almost all my liquid capital in Facebook right now. It is not something that most people would do to put the majority of their money into one stock. But
Yeah.
because I believe in Manish Prabrai's philosophy in the book that he wrote, The Dondo Investor, I believe that if you can replace the money relatively quickly, it's okay to be a little not diversified enough. And even if Facebook were to go to zero, I'd still be a happy guy tomorrow. It's So the amount of money I've put in can be replaced quickly, and that's why I haven't diversified as much as I should. If I was managing
Yeah.
millions, or even 500,000, I probably would have done a different thing. But right now, almost all of my liquid capital is in Facebook. So we'll see how that plays out. The last big gamble I made was in 2020, and I got 125% return within 3 or 4 months. So that played out really well for me. If I could do that every year, I would be richer than Elon Musk within 25 years. So that's pretty crazy. If you can get those returns, you'll be very wealthy. But we aim, well, at least a lot of the investors that I've spoken to, we're happy with just a 26% return per year. More than happy. That's delightful. It's if you can do that with a good track record, people will beat down your door. And so yeah, if you're good at value investing, even if you can get 15% every year consistently, people will come and want to park their money with you, and you'll make good money with other people's money, which we can talk about later. But
I hope you enjoyed the video, and if you have any questions or any additions to what we said previously, please write down them in the comments below. And as always, subscribe and join our community where we grow together as investors and become better at what we do in finance and investing world.